Back doing the casual Friday, and both you and I, Nick, are looking casual today. No dress shirts, just
That's
golf
right.
shirts.
Right.
Um, it's been a while since it's. I know it's really been a while since you've done one of these. Nick, Ryan, I think did the last one, and even then, that's been a few months, and so it feels like a lot's been going on. And even though we haven't been doing casual Fridays, or maybe even the podcast as consistently, it's, I would say, in large part because we're working directly with clients with what's been going on with these haywire markets and what's been going on with their portfolios. What are you hearing the most from some of your clients that you're talking to? Is everybody keeping cool, metaphorically?
You're right. Yeah, definitely not cool here in the Central Valley, but yeah, metaphorically, people are staying cool. They're kind of rolling with it. We've had three good years to fall back on. So we kind of, this is the price of admission for those long-term gains.
Yeah, I mean, it returns, S&P returns teens, double digits, in the 20s, even I think in 2019. All right, I mean, it's been really good. Even in our COVID year of 2020, things were looking really, really good, despite a 30% dip, like one of the fastest in history. But that was then, and this is now, and things have gotten. Things were looking better and then getting ugly. I think what we can probably start by doing is kind of talking about, we can just kind of talk about markets here. I'm just going to pop in with my computer screen. This is showing year to date, but here's just the last 5 days of the S&P 500. Might be a little bit hard to see here. The blue is S&P 500. Dow is the orange line. Small caps, or the Russell is yellow. Russell's down 4.7%. Nasdaq's down almost, which is the purple one, is down almost 4%. And it seems like a reaction to jobs, perhaps, I guess, today.
Yeah. I think that's for today. I mean, this, as that headline says, a 6-day losing streak for the Nasdaq. So going back to last Friday's speech by Jerome Powell, the Fed chairman, right?
That was really the killer, wasn't it? Because it looked like things were improving pretty steadily. I'll pull the stream back up here. It looked like we bottomed in June here, where this line is, and then we rebounded. Well, I mean, I think it was almost like a 17% rebound on the S&P, getting back up, and then right here is where you see everything turn back down, and that's Powell saying, essentially, expect some pain. Don't expect us to take our foot off the gas in terms of interest rate increases, and markets, investors hadn't planned for that.
No, they hadn't. Yeah, we kind of were, like you said, going along pretty well there from it was about 6 or 7 weeks of decent returns, and it was looking up, and then what they do, they pour water on the fire, for sure.
I think a lot of the question was whether this was a bear market rally or if this was the start of a bull market. And I guess we're getting the answer to that question.
We'll see. We've got a little bit ways to go to that bottom in June. So, maybe that'll hold. Maybe we won't retest it, but
yeah. Well, I guess we'll see, because it's not uncommon, right? If we're in a bear market for, markets to move up, kind of give a bit of a head fake, and then correct back down, and kind of teach everybody yet another lesson. Yeah. But that's where we get that kind of last capitulation also. So even though we've been down pretty considerably in the last week or so, that may not be bad news. It might be telling us that we're closer to the end than we are to the beginning, which I think is helpful. So we have a few charts to go over. Usually we go over 2 charts. Each of us will have picked out 2 charts. What we did a little bit differently is that Nick and I picked out a chart each, but today's jobs day, and we got the jobs report. And so I guess we could go through some of those numbers. We can start maybe with the unemployment rate. So this is from the Federal Reserve, the chart. The graphic is from the TKer Substack, which is the TKer is a financial blogger. So that's where
Sam Rowe, is that him? That's him, right?
What's that?
Sam Rowe, that's his name.
Sam Rowe, that's right. That's exactly.
He's a good one.
Yeah. He's good. He used to write for Axios. Anyway, so these lines are his, but the charts are from the Federal Reserve. But you can see here, 3.7% unemployment rate. I don't want to parse too much, but it looks like it's ticking a little bit higher here. I'm not sure this is why markets were dropping today.
Well, and I think this was kind of so. The market was up nicely in the first thing in the morning, and then just kind of bled and rolled over throughout the day. But this is kind of like what they were hoping for, from what I know. Right, is that we come off the historic lows of unemployment, and if it doesn't go up too fast, then maybe they can still engineer that soft landing in the economy that they were talking about.
Right.
So this was kind of, probably one of the reasons that the market rallied in the morning.
At first, I guess we will do a postmortem and find out a little bit later what was actually going on midday. But you're right. The pace of adding jobs this week was not, or this last month for the reading of August, obviously not as much as we had in July, but still good. I think pretty clearly the trend is lower here if you're looking at this, which is
right.
Probably okay. I mean, if you're running real tight, I mean, I don't know how many jobs you're going to be adding if we have unemployment rates somewhere in the 3 or 4% range.
Right.
And I think interestingly, 152 million, 153 million employed. I mean, we're reaching pre-COVID levels that we had before. I know we can slice it a little bit thinner. On the Odd Lots podcast, they interviewed one of the Fed board members, Neil Kashkari, and he was saying, it's not just the number of employed, because you have the number we've had in the last couple of years, people retiring, leaving the workforce for whatever reason, long COVID, caring for family members, whatever the case is. So this doesn't tell the whole story necessarily, but man, this means the labor market is tight, it would seem. And if the Federal Reserve has two responsibilities, one is full employment and the other is price stability, seems like they've checked one of those boxes.
Right, definitely.
Which I guess gives them the freedom to really continue cranking on interest rates. Last I saw, the Federal Reserve investors were banking, I think there's 75% chance of the Federal Reserve raising rates 0.75% here in September.
Okay.
You want to go on the record with a guess? What do you think? 50 basis points, 75? Yeah,
I'd say they do 50. Sure. So it's the end of September. So between now and then, right, we'll get CPI, which, the measure of inflation, we had a good number last month, which kind of helped continue that rally that started in late June. And then following that is PPI, which is the producer price index. That was a little bit better. And then I'm sure there's lots of data obviously coming out all the time. So it's probably more. So 50. I'll say 50.
Right. Well, and if we're data dependent, right, it could change. We might be thinking one thing and getting another. God knows in June, everybody was thinking one thing and ended up getting another. And so if anything, they keep saying how they're nimble and it's dependent on the information that they have. And so they could change their minds between Fed meetings. Nothing is made up here or decided, I guess is what the word I'm looking for.
Yeah. As they, you mentioned that Odd Lots podcast, I listened to that as well. And that was, one thing that he stressed was, they can do what they want. They're nimble. They've got the tools that they think they need, and they'll data dependent.
I think it was an interesting notion that they eventually push it up to like 4.5% and then just leave it there for a while.
Right. The
idea to roll over course get clawed back is maybe not in the cards. It seems. Another thing, not that podcast was putting pressure on markets, but you start adding these things and they're all bricks that kind of build a wall, so you can understand what's going on. So let's pull up your chart here, because I think this is a good place to kind of insert. This is the number of the highest frequency of large intraday swings since 2008. And today, you mentioned, as we just were jumping on, today you can add another one to this list.
Right.
What made you choose this chart as something to focus on this week?
Well, it just, certainly compared to last year, as we can see, and even, compared to 2020, as we were getting into, spring of 2020 with when we were first realizing, what COVID might look like to markets, it was definitely volatile. But this year is, as you can see from the chart, almost 90% of the days have had a range greater than 1%. So, for example, today, like you said, was another one of those.
Yep.
I mentioned earlier, the market was up. It was up about 1%. So that's 300 some points in the Dow, 30, 40 points in the S&P 500.
Right.
And then it just midday kind of rolled over, and we ended up being down 1%. So that's a 2% swing essentially.
Yep.
So even half of that would have triggered this this chart. And so like it's like you said, since 2008, right? 2008, obviously the financial crisis, and then 2009 as we were coming out of that. And as markets make a bottom, they're going to be more volatile. And see some of the other lines there. There's a recession in 2002. There was the dot-com crash in 2000, and
right.
Even in the late 90s, the market was running like crazy, and so there was volatility there. But this happens when markets go down, mostly, as you can kind of see. Like
yeah, and it's always relative,
2002, 2008. Mm-hmm.
It's relative, right? So like, yes, we're getting whipped around kind of at historic levels, but then when you take a look at last year and compare, say last year was maybe slightly below average in terms of intraday swings. And then so you have a relatively calm year, then punctuated by a historically volatile year. It's going to feel like you're getting whipped around even more than you might actually be. But no matter how you slice it, it has just been a roller coaster ride. I think that's the only way to describe it here.
Can compare that. Just one quick thing. If you look at 2017, it almost looks like that, they forgot some data there, but I don't know what was, maybe I don't know what was going on, because there wasn't really much going on in the markets. It was just kind of calm and steady. From what I remember, it was a pretty good year.
Well,
I know we had Trump tax cuts and things like that, but
well, it was a midterm year, because the Obama was elected in 2016. No, I guess it wouldn't be a midterm year.
Yeah, it would have been Trump's first midterm.
Which historically are really calm years, I guess. But you're absolutely right. It looks like it's missing data. It's like
it's like we forgot it, but yeah. Anyway.
But 1992 was another presidential election year. The year that followed that was pretty calm.
Yeah, sure.
So, and then you have a midterm election year, 94. That's when the Republicans took over Congress with the Contract with America thing. Following year, really low. So, I'm not trying to draw correlations out of this that maybe aren't there, but, kind of haphazardly, you look at election years, whether it's presidential and midterm, tend to be a little bit more volatile, I guess. Although 08, 09, that was the year after presidential election year. You can look at that. 2001 was another year after a presidential election year.
Yeah.
So it's not a perfect correlation, but volatile nonetheless. This confirms what everybody's feeling.
Yes. Yeah, that's right. Yeah. Confirmation.
Okay. Well, we can finish up then and take a look. I love the seasonal charts. I'm even talking about your chart in the term of like election seasonality. I like this chart because it shows kind of historically, not just overall, but in the past 10 years, past 20 years, since 1950, how months of the year have tended to be. And I think, a lot of us think that, January is usually pretty good. And in the past 10 years and since 1950, that's certainly been the case, although maybe not in midterm election years, which would be a year like this. But September is 1 month kind of across the board that's really, really crummy. And it feels as though we've already started this September slide. I mean, we're 2 days in and we're not doing very well. But I think importantly, we started the September slide maybe even a little bit early at the end of August. And so this probably isn't going to, maybe a bad September or a rocky September shouldn't surprise anybody here. I like this chart more for what it shows in the fourth quarter, though, than what it shows in September.
It would be nice to get a couple of those, like the gray bars there.
Yeah,
that would be a good way to end the year.
Absolutely. I think, if we do hold true to form, you looking at just the gray bars on this and looking at midterm election years, you could envision a scenario where we could chop the losses in the S&P 500 or whatever portfolio someone has perhaps pretty significantly before the year is out. Meaning we may not get back to the all-time highs that we were at in January, but if you have a much smaller hole to dig out of when you start next year, that's a heck of a lot better than the alternative, which is sliding all the way through. But just as telling in October, November, December is that just like all 4 of these kind of bars are showing bad performance in September across the board, they show good performance in the fourth quarter of the year. In those midterm election bars, my guess is those October returns and certainly the November ones are kind of clumping around the election, because it's not whether, and we could go over the slides that show it doesn't matter if Democrats or Republicans win. It just needs to have the question decided.
Right.
There's that relief that investors can now proceed accordingly, regardless of who's in office.
Yeah, definitely. One thing the markets don't like is uncertainty. And so we've kind of seen the odds of whether, which party will take either House of Congress. That's kind of flipped lately, and it'll probably flip and flip again. And so more volatility from now until early November maybe. Sure. So we'll see.
I think so. Like I think the takeaway maybe from this is, yes, we're still in this mess, but hang tight. Like, don't lose patience yet. One could argue that this bear market started at the end of last October. Right. Yeah. And so if this goes for 12 months. Okay. But you don't quit the marathon in the 25th mile just because, we're in month 10 or 11 of this bear market. Now is not the time to lose your patience and bail out and go the other direction. So, if anything.
Yeah. And just kind of tie it all back to what we said earlier. Like I said, this is the price you pay for those long-term gains that the market, typically provides. Some bouts of volatility, some drawdowns. But if we're steadfast in our approach and don't hit the panic button, then typically we'll be okay.
Maybe next time we'll pull out that JP Morgan slide of the long summers and short winters and those kinds of things. I think that would be a good one. And the intra-year drops versus where we finish. I would say, 2018, midterm election year, interest rates are rising, markets are puking for like 3 months in a row, and it ended up not being too bad by the end of December, and that's because we had that last 2-week rally at the end of that time. I mean, there's similarities to 2018 going on as well. It's just there's not enough reason here to lose your nerve. This is not 2008 all over again, so we got to stick with it. So, well, good. Well, Nick, I'm going to let you go and enjoy your weekend, or your Labor Day weekend. Are you staying in town? Are you going to escape the heat? What are you doing?
We'll be here. I'll definitely get some pool time to stay cool.
Yeah, there's nowhere to escape. You go to the mountains, it's going to be hot. You're going to go to the beach, it's going to be hot. The only relief is in the pool or a movie theater, I think.
There you go. Yeah. One thing I did hear: $3 movies tomorrow. They'll re-releasing like older movies. It's National Movie Theater Day. So
that's cool.
Do some bargain hunting. Cool.
I will check it out. You're talking my language right now.
There we go.
Well, good. All right. Well, have a good Labor Day weekend, Nick. We'll do this again soon.
Thanks, Brian. See ya.
Yep.